I am happy and proud to be able to present and introduce David Imus. David is a principal in the healthcare practice at CliftonLarsonAllen, where he specializes in delivering assurance services to nonprofits and government health care organizations. He advises hospitals, health systems, and senior living providers throughout the Western United States, bringing a practical and forward thinking approach to financial and operational challenges. David, it's all yours.
Thank you. Thank you. Appreciate that. Hey God. It's my is that working? Am I working? Okay, great. Thank you for that great introduction. It's been I appreciate the chapter, of course, for inviting me back to the HFMA stage. It's been a while since I've been up here. Today we're going to be finishing out our day talking about fraud. So, like Christian said, I'm David Imus. I'm a licensed CPA in several states, including this one. What I do for a living is I help financial professionals, among other things, manage risk. I've been doing financial statement audits since about 2012, and I've been working with hospitals for almost as long as that. I've also, along the way, done a couple of forensic consulting engagements where there has been instances of fraud where we brought in to do insurance recoveries and that sort of thing when there has been instances of fraud. So, what this presentation represents, I'm motioning like there's something behind me. There isn't. What this represents is a collection of information that represents real life ideas I want to share with you. Today is practical. These are lessons from real cases with measurable impact. These are prevention activities that you can do and apply quickly as early as Monday morning when you get back to your organizations. So I understand that we're starting just a few ticks late. I think I can land the plane on time. This presentation usually runs a little bit short anyway, so we might even get out of here a little bit early. Not really seeing any groans from anybody there on that, being that it's the last presentation. Oh, there's one. I got a groan from Marie. So I also don't say good afternoon. Wait, that isn't good enough. I said good afternoon. Because if you're a speaker and you do that, I automatically distrust you. If anybody else said that, I'm sorry. So, two quick notes before we dive in. First, this isn't about pointing fingers or laying blame. This is about patterns and controls. We'll have some time for Q&A at the end. I promise I'll leave time for your questions before we finish up for the day. But if I say something that's unclear to you, um, we can stop and I'll try to address it along the way. So before we get into the content, I want to do a quick visualization exercise with you guys. So I want everybody to close their eyes. Everybody close their eyes. It's like church. So think of somebody you work with. This person is a trusted finance professional. This is somebody who's worked for your organization for a long, long time. They have deep institutional knowledge. This person most definitely has the confidence of peers, senior leadership. They might even be a member of senior leadership. Okay, keep that keep that picture locked in. You have it? Everybody has their person. Good. Now let's shift gears a little bit. Keep your eyes closed. Now picture somebody who is intent on committing fraud, somebody who wants to defraud your organization, somebody who wants to exploit weaknesses in internal controls over a long period of time. Now, what I want you to do before I move on, everybody have that person in their head now? Okay, good. Now compare the two. Were the images the same? Were they the same person? I see a few head shakes. For most people, the answer is no, they weren't. But in reality, a lot of times they are. We tend to imagine fraud being committed by, you can open your eyes, by the way. We tend to imagine fraud being committed by somebody who's hunched over in a hooded sweatshirt in some dark basement or cramped apartment somewhere, some faceless kind of villain character. But that's just really not the case. A lot of these real life cases of fraud that we're going to talk about today were committed by people who had the keys to the castle, people who had institutional trust, people who have a lot of responsibility. They looked, quite frankly, like a lot of people in this room today. So here's our roadmap for the content. We're going to discuss why fraud matters now. 5 common fraud schemes. We'll talk about them in terms of buckets. You'll find out 3 real cases of fraud that actually happened in a healthcare environment, and measurable impact that you guys can carry back to your organizations and implement an action plan. This is designed for finance and revenue professionals just like yourselves, people who hold the keys to controls and trust. And I'll do my best to keep this pragmatic and practical, things that you can implement Monday morning when you go back to your organizations. Now, let's start with why healthcare is uniquely vulnerable to fraud. So, this might be the most impactful visual I will show you today. Look at this 60%. 60% of all federal fraud recoveries. Are you not? There you go. Thank you, Am. Appreciate that. So here in the dark blue, we have 60% of all of federal fraud recoveries are attributable to healthcare. That 40% you see on this visual, that's the field. Guys, as healthcare professionals, we're doing laps around the field in this area. Why is that? Why is healthcare so susceptible to fraud? Well, lots of reasons. It has to do with why we're here today. It's complex. There's a lot of complexity in what we do. We deal with vendor relationships. We reconcile accounts. We approve payments. We negotiate payer contracts. There's a lot that goes into what we do, and that's part of what we're learning here today. We're also, as finance and revenue professionals, we're also uniquely qualified to understand those patterns, to detect it and prevent it from happening in the future. Why? Because finance and revenue cycles see patterns across departments, cross-cutting the organization that other departments may miss. Fraud detection skills, some of which you'll learn today, they protect the organization and they protect you. They protect you from signing off on something that you didn't see coming. Here's the framework we'll use. Learning how to drive here. So these are the buckets that I teased earlier. There's 5 big buckets that fraud fits into. So I want you to think of this as like a mental filing cabinet. These 5 categories cover the most common fraud that finance runs into. Now, your organization might have a little bit different or have some uniqueness or that sort of thing, and you might have a little bit different framework to think of, but this is a good baseline to start with. We look at revenue schemes. This is things like upcoding, phantom billing, unbundling services, reimbursement. Look at expense and AP schemes. These ones are particularly scary to me because this has to do with your vendor payment model. How do you pay your vendors? And this is how cash can leave the door. Same with payroll and benefits. Fraud schemes can look like ghost employees, overtime padding, benefits misused, or labor theft. There's procurement and conflicts of interest. Those look like kickbacks, contract steering, or self-dealing arrangements. And then finally, there's financial reporting. That looks like earnings management, margin smoothing, cost shifting, and things that actually manipulate the financial statement numbers. So most detection starts with one question. Which bucket could this fraud fit into? And once you understand this in a framework of 5 different cabinets or 5 different buckets, however you want to think about it, but however you visualize this, once you understand this is what could go wrong in this cycle, or this is what could go wrong in this cycle, that's a very, very, very important thing to take away when it comes to detection. Because once you answer the question, what bucket does this feel like? Once you name the bucket, the control response gets much clearer. Let's start on the revenue side. So I know this is very near and dear to a lot of your hearts, which is why I included it here today. But it's also this is a tricky one because a lot of time revenue side fraud looks documented. That's why it's hard. This looks like upcoding, phantom billing, unbundling, duplicate billing. So what are red flags? What could go wrong here? Well, red flags are pattern-based spikes in certain codes, unusual volumes, shifts in pair mixes, outliers, variances, anything that you can uncover using analytics. That's why I really encourage the use of analytics when you're looking at your payer side of your income statement. Why? Because it's a good starting point to see where fraud could be taking place. Now, I didn't prepare a lot of content or intend this to be a technology or computer assisted or AI based discussion. But in my opinion, this is one area where computer assisted controls or artificial intelligence could really go a long way to helping you understand where fraud could be happening in your organization. Because what could take you hours sifting through reports and looking for anomalies and aggregating otherwise disaggregated data, you could do with a flip of a button or a simple macro or a simple prompt in AI and say, hey, show me where my spikes are in my pair mix this month. And a lot of you work in small organizations and small communities. You kind of know who your payers are, right? You're of course going to have your governmental payers. You might have, of course you have self pay, and then your commercial pay. A lot of you, especially from smaller hospitals, it usually comes from the same payers because your community is kind of just your community. You might have one big employer in town, or you might have one big industry that dominates your town. Now, would it make sense for one payer to increase by 50% month over month? Probably not. Does it mean there's fraud taking place? Maybe, not necessarily, but it's a place for you to start looking. And it's probably a place where you're not currently looking. Now let's flip to the expense side. Like I mentioned, the expense side fraud is particularly scary to me because now we're talking about actual hard dollars leaving the doors of your organization. Um, this is literally stealing through the payment process. So, what does this look like? Fake vendor fake vendor schemes, inflated invoices. Um, this looks like invoice manipulation and business email compromise. Has anybody ever gotten an email where it's asking you, "Hey, we just need to just, start sending our payments to a different address." Is that a red flag? What if that email says, "Send your payments to a different address," and also that address is a PO box? Is that a red flag? How many of you pay your vendor invoices using ACH or EFT? There's nothing inherently wrong with that. Very modern way to pay your bills. But what if you get a spoofed email from say a McKesson or a Cardinal Health email address that says, "Hey, our banking relationships changed. You were sending it to this routing number. Send it to this routing number." If you have employees who would just do that, super scary stuff. Because all those could represent ways that employees could be spoofing email addresses or outsiders could be spoofing email addresses to divert your payments to an account that they own. The biggest single defense here is using known contact information for the vendor, not what's in the email. Always call and verify. Next, we're going to talk about payroll. And payroll is important because it's literally the biggest spend category for most organizations. So I estimate over years of looking at financial statements, 40 to 50% of your operating budget is typically labor. That's just a fact of life in our industry. We are a labor intensive industry, for better or for worse. So we're talking about big, big dollars here. Now, what does fraud look like in this area? Ghost employees, padding overtime, benefits misuse, attendance manipulation, punching time cards when there was no work performed. Red flags in this area are consistency patterns, employees who always max out their overtime, contact information being in the form of PO boxes, or supervisor rubber stamps on time cards. Now, every facility I've probably ever walked into always has the same control over payroll and time card processing. Well, the department supervisor signs off on the time card. The department supervisor signs off on the time card. But department supervisors are busy people. Do we trust that one control to control for this huge, huge area of your income statement? Is that person really doing a robust walkthrough of every single person's workday? Probably not. Next, we're going to talk about procurement. And this is kind of where ethics and dollars collide, especially in my world, which is primarily rural health. We're dealing with small communities here. Communities where people know one another. People are related to people who work elsewhere in the community. So it's particularly susceptible to that. And kickbacks and conflicts aren't always obvious. They a lot of times start as helpful relationships. So say you're doing a new construction project, you're doing capital improvement. Inevitably somebody on the board says, "Hey, I used to work with somebody who is in this field," or my wife my wife's brother is an architect. We should use them. Now, is that something we should categorically avoid? No, not necessarily. But when disclosure is missing, that's when oversight disappears. Finance is uniquely positioned to require disclosure of related party transactions, require competitive bids, and a review above market or unusual vendor behavior. Hey, are we getting the right pricing for this? Are we sure we're not violating any anti-kickback statutes? Now, this last bucket has to do with financial statement fraud, which is where the numbers themselves get manipulated. So, as we talk about these 5 buckets of where fraud can take place, what fraud can look like, we're kind of moving up the food chain in your organization. So, I would say here in financial statement fraud, we're at the very top of the food chain. This typically happens at the C-suite level, sometimes controller, sometimes CFO, sometimes CEO, usually not below your controller. And this isn't always big Enron. This could be internal pressure can cause this as well. This looks like margin smoothing or timing gains. Um, Maybe it might even start as like, let's just get through this month, or let's just get past this quarter. Just get past this covenant period, or let's get past this audit or what have you. But it escalates, especially when debt covenants with your lenders are involved. What we need to do is apply the detection mindset and compare the cash reality to reported results and investigate the differences. Why can this get out of control so quickly? Why can it snowball? Well, especially when we're talking about things like timing differences. If you have CFO who is under a lot of pressure to meet debt covenants, they say, okay, I'm just going to park this loss into next period. I'm not going to recognize it this period. We'll recognize it next period. We'll defer it. Nobody will be any but the wiser. Well, then you're relying on the next month's performance to erase that loss, right? What if next month isn't any better? And if nothing fundamentally changes your organization, next month definitely probably that next month might be worse, right? Then they have to do it again, only in bigger numbers and bigger numbers. So it snowballs and it gets away from you. So what I encourage you all to do is look at where you have a disconnect between your cash flows and what you're showing in terms of your operating results. How many of you prepare an internal set of financial statements for your organization? All of your organizations should have internal financial statements. So they probably look a little bit something like this. You probably have a balance sheet, sometimes called a statement of net assets or something like that. You probably have an income statement or a statement of operations, statement of activities, shows your results of operations. Sure. But how many of you prepare an internally prepared, not just once a year, but on a recurring basis, statement of cash flows? Kale does. That's cool. Nobody else does. Doesn't surprise me, but it's also problematic, and here's why. It's because there's a disconnect between your cash results and what you're showing on your income statement. Now, is that a problem? Not necessarily, but period after period after period of positive operating results should, over time, result in positive cash flows from operations, right? If there's not, that's something we can investigate and look at. That's an actionable piece of information. If you're not preparing a statement of cash flows, then you have nothing actionable. Now, let's make this kind of real life and look at 3 different scenarios that actually happen. So the first one, which one is this? Okay, this is a fun one. This is kind of a slow burn. Um, this is kind of a slow burn, small dollar amount one that took place over a long period of time. So Mr. Stillman was a nurse practitioner. And what he did is he created multiple tax IDs and one ghost office to basically create fake claims that he submitted through payers. Now, I acknowledge this wasn't directly defrauding a healthcare entity like where you guys work, but this was definitely defrauding his payers. And The thing that made this undetected for such a long period of time was the dollar amounts weren't huge. He didn't just ask for like one $1.5 million check and disappear to an island somewhere. This was a couple $100 here, a couple $100 there, below any kind of approval thresholds. The kind of checks that your payers just kind of process sometimes, right? Nobody really asks questions when they're that small. You just did this on a large volume for a large period of time. And sure, the web you created to do it was fairly complex, but nothing else about it was that complex. Now, what if one of your providers went rogue? What would be the reputational damage to your organization? Where would you stand with your community? What would your approach be on your next round of payer negotiations? Would you have a leg to stand on to go to your payers, your commercial payers, and say, hey, we deserve a double digit rate increase this year? Haha, good one you stole from us. You didn't do anything wrong. You had somebody go off the rails on. Now, the next case kind of shows us something kind of a little bit different. And it shows us what pressure can do when it comes to decision making. So this had to do with an organization that ran 12 SNFs, 12 skilled nursing facilities. And the corporate entity that ran all of them came up with quotas specifying patient length of stay, minimum length of stay, regardless of medical necessity. In order to enforce this quota, corporate set up an approval mechanism where facilities had to ask for approval to discharge a patient if they were being paid, if they were a Medicare Part A patient. Again, regardless of any sort of medical necessity. So this resulted in particularly Medicare overbilling to the tune of about $21 million. So this, unlike our last case, this wasn't just one rogue person going bad. This was institutional pressure and bad policy that caused this fraud. So when when business targets override medical necessity, then the fraud risk becomes systemic. So the big takeaway I want you to learn from this one is that KPIs that indirectly botch-free KPIs that you may be generating that indirectly create perverse incentives and reward risk taking. The last case here is about vendor ecosystems. So this one looks a lot more complicated than it is. So let me break it down. Daniel Hurt was a man who operated multiple entities that were fairly what we'll call vertically integrated. Fountain Health Services, Verify Health, Landmark Diagnostics were some of them. And what he was trying to do was he was trying to funnel people through his labs, regardless of medical necessity, to go through these cancer genomic tests. And there was a system of kickbacks that made sure through every rung on this ladder that I have showing you here that he got paid. Well, the first thing he had to do was he had to generate the patients. So what did he do? He called them. He literally called them on the phone. He created a telemarketing practice that called people at home and said, hey, Mr. So-and-so, you could be a candidate for this test. We'll do it for you. And it's kind of like that thing, like if I saw you in this room, okay, does your right arm itch right now? Obviously, it didn't before, but it kind of does now. And that's kind of how he generated these patients. He called them up, hey, do you have these symptoms? And the people who he was calling would be like, kind of. So created a system where he was able to extract money from payers through kickbacks. So this one is a little bit harder to see because the scheme is operational, but you as finance professionals could uncover this because the money trail is most definitely financial. So now that we learned 3 real life examples, what does fraud actually cost? So actual costs, talk about money here, direct theft, the money that actually leaves your doors in a fraud scheme, that's just the start. The real cost, in my opinion, comes in investigating fraud, legal response, remediation, opportunity cost. Those are usually way out past the initial loss. And the penalties anti-kickback statutes, regulatory requirements, reporting requirements. They don't care if you thought it was small. They don't care if your auditor said it was immaterial. That's not a legal safe harbor. But the worst damage doesn't usually happen on the income statement. So as much of a financial guy as I am, the qualitative impact, the cultural and the reputational damage is often a lot worse. So you have internal cultural damage. What does that look like? Well, the more employee morale suffers, retention suffers. Honest staff feel like they've been demoralized because they had a bad actor among them. What does external or reputational harm look like? Well, it may access your ability to gain credit, borrow money. What is the community going to think of you? What are the grocery store aisle conversations going to look like from here on out? Don't go to the hospital. Don't visit them. They had fraud. Like, wait a second, we were the victim. Even if you did everything right and you caught the fraud early, you self-reported, you punished the person, you fired the person, you're still the victim, even though you did nothing wrong, because there's that reputational harm. You had fraud associated with your name. So, is it fair? No, it's not fair at all. But it's the reality. There we go. So, 18 months, I think I teased this earlier. This is why fraud, even if it starts small, it's almost never small. The average detection time is so long, 18 months. That's the average. That means a lot of these schemes can go on for years for undetected. How much money could leave your organization in 18 months? So fraudsters touch the system. If nothing happens, they scale up. Around $100, $500, $1,500. Let's say, I'm just going to take enough to that financial pressure for me to do so is over. Just enough to pay for my wedding. Just enough to pay for my credit card. Just enough to pay off my car. Well, hey, that worked. Nobody said anything. Keep going. Pay out the house. You know what? I'm still working here. They still trust me. Let's put away for the kids to go to college. And like I said earlier, materiality isn't a safe harbor. So even if $1 million is an insured amount and it's below, not meaningful to your financial statements, still something you can be punished for. So what actually works? What can we do? So we'll give you 5 actions. So anybody who has ever been audited, anybody who's heard this from me or anybody else in the room, your auditors, number one thing, segregate duties. All incompatible duties should be segregated. The authorization, processing, recording, and reconciliation processes for any single transaction should not belong to one person. This is a must. And I acknowledge this is hard, especially for you that work in rural health, maybe. You have small teams. It's difficult to do this. It's a non-negotiable. Verify vendor changes. Vendors do from time to time change their lockbox, change their bill, change their AP address. Is there anything wrong with that? No. But you have to institutionalize and drill it into people that if you get an email saying, hey, let's change our address, you got to verify it. Analyze payment patterns. Like I said, this is an area where computer assisted technology can really come in handy. Look at your payment patterns. You guys know who your payers are. You guys know what codes are the most common billing codes. You guys know what your patterns are. So if you see spikes, the computer isn't going to be able to tell you there's fraud going on here, but it's going to tell you where to start looking. Require documentation. Make audit trails unavoidable. Who reviews the bank rec? Rotate responsibilities. So typically one person has the core responsibility for doing something. That person is the type of employee that never takes a day off. They come in when they're sick. They work through their vacations. They never take a vacation. Lots of times those people are lauded. But in reality, that's a huge red flag. Why? Fraud hates interruption. Lots of times that person isn't taking time off, not because they're dedicated, because they can't take time off, because they have to be there every single day to hit that button to make sure nobody uncovers what they're doing. So I implore on you, require rotation. Every single person who does a job in your organization should have a backup. That's just a given. Make the backup do the job for a day. Do it once a month, do it once a quarter. Do it more often than you're doing now, which is probably never. It will uncover a lot more than you think. If you do nothing else, you can start with these 3 fraud checks. Vendor master audit. We all have a vendor master file. Review it. This doesn't take any fancy computer assisted macros or AI prompts to do it, but just look at it. Flag vendors with PO boxes, incomplete addresses, documentation standards that fail your basic kind of sniff test, right? Look for duplicate vendors. Why? If you have duplicate vendors, you say you have 7 different vendors for Cardinal Health. Cardinal Health. Cardinal Health, comma, Inc., period. Cardinal Health, comma, Inc., no period. Any variation thereof. Do you really need all those? No, you probably only need one, right? The unused ones are breeding ground for fraud because an outsider or a rogue employee could commandeer those, change the banking information, and use that existing vendor who's already approved to receive payments from you as a conduit to funnel cash out of your organization. So just clean it up. It's just as simple as that. One notable example outside of healthcare where this took place was the city of Seattle. He was like a permit guy, permit official. He was the person who went around to commercial job sites to permit them, and he would collect payments from the contractors in person, which wasn't an accepted practice, but the contractors didn't know that. Well, how did he cash the checks? Well, he went down to a bank in Seattle that the city of Seattle didn't have a banking relationship with, so they weren't any the wiser, and created a bank account under the name, get this, City of C, period, SEA, period. So it was close enough to a city of Seattle on the checks. He was able to cash the checks. Nobody was any the wiser. This went on for years. Again, not huge dollar amounts, not creative. That's the thing is people who perpetrate fraud aren't typically smart or creative or anything like that. They're just persistent. They find one thing, they use it as long as it works until it doesn't. It's just up to us to figure out kind of the pathways to block off ahead of time. So vendor master audit, super easy thing to do. You can do it with your own eyes. It takes you 5 minutes. This should be on your, I would implore you to put this in your month-end close checklist. Do it once, clean it up once, and then look at any new vendors. Make sure nothing is funny going on there. Do a duplicate payment review. This is something you can automate. Implement automated duplicate payment detection beyond exact matching and date. You can look at things like that will be similar enough to where you could call it a duplicate payment. And then do statistical benchmarking. Talk to your peers. Talk to people in this room. Talk to people one town over, the next county over. Talk to people you know. Hey, what do your numbers look like in this area? Well, this is what we're seeing. Compare coding levels to patterns that you know are kind of baseline, and then you can kind of see where you're at and where your peers are at. And if there's huge big spikes or anomalies, again, that's just people perpetrating fraud, not being terribly creative. The largest case of municipal fraud that ever affected the United States could have been detected a lot earlier than it was. You know how this happened? There's 2 cities in the Midwest. They're about the same size, similar population, similar industries, similar revenue expense profiles, all that. One was being defrauded by an employee. The other one wasn't. And while this was going on, before it was detected, City B called City A and said, hey, we've seen your financials and we noticed your waste management fund is operating at a deficit. Ours never operates at a deficit, always a surplus. Every city in the entire state operates at a surplus. We think there's something funny going on with your financials. You should look into it. You know how City A responded? They said, aha, good one. Nice try. We'll sort this out on the football field on Friday night. Kind of typical city rival response. But if they would have taken heed to that, they could have stopped, literally, not figuratively, literally millions of dollars of loss. Just by doing some kind of simple benchmarking. Not rocket science. Not anything that requires any special talents or anything. Now, as I promised you really practical information. I know we all leave these conferences on kind of a high, like, yeah, we're going to do it. And then real life sets in and our day to day sets in and the emails start and the phone calls come in. I'm going to give you the simplest possible call to action, the simplest possible thing I can think of to get you started down the road of thinking about this in a way that's meaningful and actionable, something you can actually do that is not a heavy lift. So, if one process, I don't care what it is, doesn't matter. Maybe it's something that an auditor or a regulator has pointed out before as maybe having some holes in it. Maybe it's based on this conversation that we've had just now, you're kind of nervous about, but just pick one process, something that you think has some risk to it, has some hair to it, right? So, this is your highest risk process. So, it could be based on complexity, dollar volume, transaction frequency. I don't care what your criteria is. Just pick one process and then take 30 days. Take 30 days and do the following. Document who authorizes, who approves, and who reconciles everything in that process. And I guarantee you, during those 30 days, you will uncover gaps. So what do? Do some testing. Reach into that transaction stream and look at 20, 50 transactions. Is there an auditable trail? Did those invoices actually come with a receiving report? Were those claims actually supported by a medical record? If the answer is no, then you know what your job is, right? So once you identify specific control weaknesses like lack of segregation of incompatible duties or inadequate documentation, then you know what to do. You just shore those up. And then this gives you something you can present the findings to leadership or your board with recommendations. And the best part is this doesn't really cost you anything. Then follow up in 90 days. See if it got better. I guarantee you it will. What do you do after that? Rinse and repeat. Look at your next most risky process. And I guarantee you, after a year of doing this, you're going to have a lot more solid system of controls than you did before. And this isn't for the benefit of having a clean audit or anything like that. This is for your benefit. This is for the benefit of having peace of mind that, we do have a strong system of controls in place to prevent and detect fraud. So let me summarize the key takeaways and then we'll open it up. 5 predictable patterns, 3 real life cases, and then impacts that are qualitative and go beyond the dollars spent. And then we talk about simple controls that if you apply them consistency can have a high impact. So your next step, do that 30-day plan. Review your vendor master file. Implement phone verification. Talk to your people. And I guarantee you'll be better off. I want to take this time to thank you for what you do. And I want to remind you that you guys are really important to this whole process. You work in finance, and finance is stewardship. Stewardship is healthcare. If you want to talk through a specific scenario that you want to share here on the floor, I'm happy to do so. My contact information is wherever it is there. So yeah, call me. We can talk through it. I'd be happy to nerd out with any and every one of you. Again, thanks to the chapter for having me. And we'll pass the mic around for questions.
I actually have two questions for you. I'll start with out of all these frauds, which one you see is more dominant or more prevalent that you see more often occurring? And also, the 30-day audit can be cumbersome, right? You hear that all health systems and healthcare providers are really constrained with resources. If you hear that from your clients that you're working with, how do you respond? What do you recommend? How to help with getting some audit process while being conscious with lack of resources?
Um, Thank you. Those are both really great questions. The first question, which one do we see at a higher rate? I don't know. I don't know if I have a good sense of what's happening out there on a higher rate than others. I can probably find out. One thing when I was kind of researching this content is data about fraud and the existence thereof is really hard to come by because a lot of times when it happens, organizations kind of want to keep it quiet because a lot of the reputational risks that I manage. But I will try to answer your question by saying this. The type of fraud that scares me the most is the ones that are perpetrated by low to mid-level employees that can go up, that's relatively small in a per transaction dollar amount, that can go on for a long period of time because those add up. Those are so simple to do, and the dollar amounts can be so huge, and the downside risk and the reputational loss can be so huge. Those ones scare me the most. Things like financial statement manipulation, those sort of things, I think those tend to make the headlines a lot, but I think those don't necessarily involve in cash leaving the door in the same way. Does that answer your question? Your second question, I acknowledge that, and it's hard for me as a busy professional like you to take the stage and ask you to do one more thing. So I acknowledge that everybody's busy and this can be burdensome. I would kind of flip that on its head though and said, based on a lot of the content that we talked about today, you can't afford not to, because a company, an organization that has weak controls and management isn't thinking in these ways is ripe for this sort of thing to happen, because we all have employees and other stakeholders who have all three legs of the triangle: opportunity to commit fraud, rationalization to do so. Maybe they only got a 2% raise last year, right? So they're mad. And then pressure. Maybe they had a spouse who died. They lose an income source in the household, right? And so if you're not thinking in these things this way, you're just kind of setting yourself as an easy target. And the last thing I'll say to that, to kind of close the door on it, is what I really tried to do, um, when I was setting up this kind of challenge, this call to action on this slide here, is make this something that's a very light lift, that's very easy to do. You're not having to hire consultants. You're not have to spend money. You can do this on your own with people and resources you have in your building. That doesn't take a lot of time, but has a really big payoff in terms of peace of mind.
This is more of a comment than a question.
Sure.
We actually ran into a small situation that I thought would be helpful for the group to hear. Um, so we had an employee reach out that had submitted an expense report, and we had denied something on the expense report that was originally approved by their supervisor because it wasn't our policy. And so we do a routine check of some of our expense reports. And so we had a conversation with the employee and said, here's the policy. This is not, something that we normally do. Well, we ended up taking a look at some other stuff going through the expense report, ended up finding that there was some other stuff on there that was a little odd. And so we actually have a policy for administrative ease where anything at $25 or lower, we don't require a receipt,
Yeah, same.
right? So, most companies have that. Well, as we were looking, we found that this particular employee was putting $25 and $25 and $25 and $25.
Jeez, every time you put gas in the rental car, it was like $24.98. So
Well,
it was weird, wasn't it?
and it wasn't even that. It was literally $25. So they weren't varying the amounts at all. They were just putting $25.
Oh, he's bold.
Oh yeah, it was the same amount. So we had to take care of that. But I mean, to your point about the, items that are small that, go undetected or a part of, some of these policies that we have, that this could go undetected for a long time. Luckily, we actually caught it relatively early, but we may have these types of policies that are in place because they do make things easier, but this also can turn into something not great. So we do need to do these types of reviews, just to your, point, and make sure that we're, doing the proper checks, even if we do have these particular policies in place.
For sure. for sure.
Yeah.
And for those of you who don't know Kale, he works at a big organization, lots of resources, right? And this still happened, right? So if it can happen to Kale, it can happen anywhere. And, we only have so much time together. I didn't even get into expense report fraud. I'm really glad you brought that up because that's one area that's just absolutely hugely susceptible to fraudulent behavior. So I'm glad you're thinking about controls in that area. But what could you do to prevent that? I agree. The answer isn't to require receipts for every single transaction because that 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 defeats the purpose of the policy. The policy is to remove administrative friction, right? Which I tend to agree with. So there's nothing wrong with the policy. But what could you do to uncover that? Well, you could just look at a simple like Benford's law test that looks at frequency analysis of certain transactions. And if you see that more transactions than others in a given population, this population being expense reports, it starts with the number 25. Well, guess what? Bam, there you go. You have a place to look. Again, something like that isn't going to tell you, yes, there's definitely fraud right here. Handcuff the guy. It's going to tell you, look here. There could be something fishy going on. So I'm really glad you shared that, Gail. Thank you. Anybody else?
So the tips I heard, keep my fraud low, vary the amounts. Is that is that the main takeaway?
You passed the test. That's
Cool.
correct. That's correct.
No,
Yeah.
I think expense reports are really a weird thing, right? Because a lot of us are traveling right now. You don't want a lot of friction on expense reports. You're like, gosh, I lost that one receipt for $50, so I'll put in two different under $25 expenses. I mean, and that's just low level justification. These justifications start really early. If you leave these checks out of the system, even good employees can start committing low level fraud. That's really
100%.
what I wanted to say.
Yeah. Then you bring up a really good point about it starts small, right? It's like, oh, yeah, the restaurant didn't give me a receipt. I didn't want to go into the gas station to get my receipt, right? So I'm just going to split it up. Nobody will be an advisor. And I think that speaks to something we didn't talk to about in the content that I'm not going to spend a lot of time here on, but it has to do with culture and tone of the top. And employees need to feel empowered. Say, hey, I didn't do anything wrong. I just didn't get a receipt because of nothing outside of my control. Let me talk to my supervisor, see what's going on, see if there's a fair way to look at this and create like an exception log or an exception report rather than do the thing where you just kind of go dark and just circumvent the controls because that's where things kind of start to break down. But in order to do that, you need to have that kind of really good tone of pop, really good culture of trust, really good kind of company culture to support those types of conversations.